Good morning, everyone. This is Chris Kimble. Welcome to another edition of your Daily Five. Today's April the 20th. And today I want to just talk about beware of setups that headwinds could be in the face of passive investing. I want to also talk about how mom and pop have historically large exposure to equities at this time and what it's meant in the past. I want to share the corporate bonds versus Fed funds spread rate. Are investors frogs in a pot of boiling water right now and they don't know it? I want to discuss that. And then possible tailwinds for gold and the upside targets that we feel. And we're also going to share that silver has been trapped inside of a 15-year pennant pattern, and the breakout could be huge. Sometimes often people talk about how long's technical analysis been around, and this is a look at the Dow. And I'd like to say in some ways it's probably been around over 120 years because when you think about the Dow, people talk about the roaring 20s, but in my opinion, it was just the roaring 4 years. You see overhead resistance from 1905 to 1925, then just rallied up 4 years. And then what did it do? It loses 90% of its value and comes back to the bottom of its 30-year channel. So whether people were actively in technical analysis at the time, it still appears to me that charts, have memories. For those that were unfortunate to invest in 1929 at the high, it was a lost 25 years. Here's the sideways pattern. And so what these are all about, folks, is, the bull markets is when the wind's behind you and passive shines. And these are just sideways markets where active shines. And this is just ideal for StockCharts members. So I think we're coming up to an ideal circumstance for people that use these services. I was fortunate that Sir John Templeton shared with me in the late 90s that he thought we could experience a flat decade. In other words, the wind could be in the face of investors. So as we can see on the last 120 years, there's been a few of these flat markets. Once that breakout from 13 years happened, we saw a strong rally. But I think we got to ask ourselves two questions. Number one, do you know what conditions were commonly in play at the start of these prior lost decades? And could history be repeating itself? So one of the things that Sir John Templeton shared with me was something simple as this. How does the level of stock ownership impact future returns in America? Right here, he was just showing me that it was the highest amount of stock ownership in the American households in 2000. And that's where he said, I think a passive will struggle and active will do fine. You can see that as of recently, we just had the highest exposure in 60 years. So this tends to say wins in the face of passive, great for tailwinds for active management. If you look at another one, we've been hearing a lot about yield spreads, and the bottom line is when you look here at the 90s bull market began here, the 2003 stock market lows were here. These were a time when the wind was behind passive. These were times when the winds were in the face of passive and active shined, and you can see that it's now at more extremes than the dot-com highs, the financial crisis highs, and the COVID stock market peak. So some really interesting times for active management. I'm not going to go through them all, but these were the things that Sir John Templeton shared with me in the late 90s. You can look at this recording a little slower, but from equity exposure to low liquidity to the Buffett indicator, the Hussman model, bond yields minus Fed funds rate, the Schiller model, and U.S. equities are at the highest valuation to Europe in 50 years. These all just suggest that the memberships that are here are in the right place, that StockCharts members should do extremely well for years to come. I found this interesting last week that somebody on Twitter put that the 1, 2, 4, and 10-month rate of change was just nothing more than plus or minus 1%, and that was only the third time since 1928. As I looked a little bit further, essentially we've gone nowhere in 2 years. We saw last year was the latest blow to the 60-40 model that mom and pop are leaving things. And what I'm most concerned about is that investors may be frogs in a boiling pot of water and they don't know it. They just think that things are over, but maybe they're not aware that this thing, could continue. So I think some wonderful opportunities are going to come, and there's a real inflection point here. We're looking at the dollar on the top and the S&P on the bottom. You notice this inverse correlation. So the dollar is obviously testing support around the 100 level, and the S&P is testing resistance. So I think we really need to keep our focus on the king dollar and what it's doing. And the reason I say that is this is the US dollar, and we looked at a 100-week rate of change. And you'll notice in times in the past when after 100 weeks, which is essentially just 2 calendar years roughly, that when the dollar was up 20% here, 20% here, and nearly 15% here, the dollar struggled and actually fell, which became an opportunity. So a break of 100 here, to me, sets off a tailwind for the metals. And if it breaks down here, the dollar could float down over time to the 88 level. One thing I just want to remind people is, it's just sideways channels and the opportunities that they create. This top piece here looks at the Dow going back 100 years. And essentially it showed that it went nowhere for 16 years, but then once it broke out, it never looked back. And so we see a similar rally in gold for this was 12 years up. We've had a sideways pattern. And so someday the odds are good that gold's going to break out from this channel. And it could be some great tailwind opportunities for it. Wanted to share our upside targets that we've been sharing with our members. To be prepared, we believe that a gold super cycle could be starting. And there's some uniformity in pricing. You see it was essentially 12 years up and 12 years sideways. One of the things that's difficult for all of us is once a sideways trading pattern breaks out, and a breakout has not taken place in gold, but how do you know what upside targets might come into play? So I have found in my past 43 years that Fibonacci is a great friend on looking for upside targets. So we applied to the low of 1998 on gold, the recent high of just a couple of years. And so we believe that once, if we can get King dollar weakness below essentially the 198 level, and we get a breakout in gold, that the first target that should easily be achieved is 3,000. And it wouldn't be surprise me over time that gold runs up to the 5,000 target. We all, despite, even though I've been in this business for several decades, we all have the same ability, regardless of experience in this business, to look back in hindsight. And this looks at silver on a quarterly basis. And I guess a couple of things that come to mind here. This is one of the largest pennant patterns. This is essentially 17, 18 years in the making. Pennant patterns tend to frustrate investors, both bulls and bears. And why is that? Well, essentially, if you're bullish, you just keep experiencing lower highs. And if you're bearish, you see rallies off these support levels, but it just doesn't seem to break down. So a couple of takeaways from this is the large quarterly, this is again silver quarterly, so large reversal wicks tend to send long-term messages. You can see a bearish reversal here. Silver struggled to get above that level for 15 years. And essentially it had a over 50% decline. You can see two bullish reversal wicks here. You can see a bearish one at the top. This looks to be one of the larger bullish reversal patterns in the history of silver as it's facing resistance. Bottom line, the takeaway from this is a breakout or a breakdown from silver should be huge, and we favor the breakout to the upside. 11 years, in September of 11, I suggested that the Swiss franc was suggesting that gold would be flat to down for years to come. The price was 1,828 at that time. A couple days before Christmas, it was at the same price again 11 years later. It's not the point of the same price. It's just about using models and currencies, everyone, to be your friend. And we're of the take that due to numerous price patterns, the exact opposite situation looks to be in play from 2011. In our opinion, odds are high that gold rallies for years to come. So in summary, beware of the setups for headwinds. We see many of them are in place. Mom and pop do have a huge exposure to stocks. We see many spreads that are suggesting that active management, not passive, should shine. I do wonder if people are realizing that there are possibly that passive investors are frogs in a boiling pot of water. Tailwinds should be good for gold and silver for the upside for years to come. I thank you for your time today. Members of StockCharts do receive a discount for our services. You can receive those if you're interested in more of our research by going to Kimble chartingsolutions.com/StockCharts. Thank you, everybody, for watching. Have a great day.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.